Hello and welcome to Super Informed Radio, a UniSuper podcast. My name is Lyndon and it's the 1st of July in 2026, which means we have just wrapped up another financial year, and it has certainly been one to remember. We've seen conflict in the Middle East dominating headlines, we've seen wildly swinging oil prices, and of course, we have witnessed the seemingly unstoppable rise of artificial intelligence. Almost as unstoppable is our friend David Colosimo, UniSuper's head of fixed interest. He is here to help us take stock of the year that was and, of course, look ahead to what might be in store for July. David, happy new financial year and welcome back.
Thank you, Lyndon, for that great introduction.
David, let's quickly cover off on markets for the last financial year. Now, it did have its fair share of drama, as you know, but it was also another year where Australian shares just weren't able to keep pace with the rest of the world, wasn't it?
Yeah, true. Australian shares are up just 6% once you include dividends. I suppose that's a modest return. But as you say, that's quite low if you compare it to a list of the other major countries and regions. So the US returned 22%, Europe 22%, China 30%, Japan 43%, so all significantly stronger. And then some of the smaller countries are even more impressive. Taiwan up 112%, which is more than double. Korea 179%, so nearly tripled in just 12 months.
My goodness. Actually, let's just unpack that a little bit. So we've got Taiwan and Korea sort of at the top of the table and Australia very much at the bottom of the pack there. I'm assuming it was Taiwan and Korea's centrality, if you like, to AI that was causing those kind of returns. Is that right?
Yeah. Last year was definitely the AI trade that helped to dictate the winners and losers. It was a boon for companies that are enabling the AI capex boom. And as you said, top of that list is the computer chip manufacturers, hence the strength in Taiwan and Korea, and large parts of the US market as well. In Australia, we only benefit indirectly through the resources sector. So resources actually returned a pretty massive 50% for the year. But we also have plenty of companies, especially in communication services and IT, for whom AI might be more of a threat to their business models. So we saw a lot of derating. Australia's IT sector was down 37% for the year. WiseTech was down 70%. It also didn't help that the RBA were very aggressive in hiking. They hiked 3 times because of strong inflation, and that was seen as a real headwind for the domestic economy. And then finally, I suppose there were enough company-specific stories as well. I've mentioned the problems at CSL more than a few times over the last 12 months. It was down 52% for the year.
Let's bring things back to the month of June for a sec, David. So, of course, the big headline was that the US and Iran had finally agreed to, let's say, quote unquote, end military operations. And we're probably all familiar with the fact that the oil price has since come down a bit. That sounds like it would be good news for shares, but we sort of didn't seem to see much of a boost. Why was that? It's
a fair point, Lyndon. US shares were actually lower in the month, down 1%. Australian shares were up about 0.5%. So, not a great month, on a bit of an average month, I suppose. In the end, I think there's a few reasons why we didn't see more of an impact from those lower oil prices. And the first and probably most important is that the market had already been expecting a resolution for some time. So a lot of it's already priced. And the second thing I think is that the agreement we have now it's still not final. There's a lot of disagreement about ongoing inspections of facilities, whether Iran will be able to toll the Strait of Hormuz. And then also it still just seems that peace is still quite fragile. So it's not quite over yet. And I suppose the final thing is that oil prices have fallen. Their impact on bond and share markets has fallen as well. And a lot of other issues have come into focus.
So what is driving markets now then, do you think, David, if it wasn't oil?
Well, a few things. As oil prices have receded, it's refocused attention on the fact that the US economy is quite resilient at a time where spare capacity is quite limited and that inflation is also too high. The US economy's already had to absorb higher tariffs, higher energy costs. Now it's clear the AI boom is pushing up the cost of electronics as well. In the last few weeks, both Apple and Microsoft, for example, they announced big increases to items like iPads and Xboxes. That's helped change the narrative around interest rates. It wasn't that long ago the Fed was still indicating that the US economy may need more rate cuts, but that's now completely changed. The big surprise from the Fed meeting this month was that about half the committee members now think the Fed will be hiking rates again later this year. Now, on top of all of that, we have changing dynamics in the tech sector, so that's having a really big impact too.
And what are some of the other changes that we've been seeing in the tech sector, David? Are you able to talk a little bit about that?
Yeah, I think there's been a lot more focus on the cost of AI compute. We're hearing a lot more reports about companies wanting to rein in the growing cost of providing AI access for their employees. And there's also a bit more of a threat about AI regulation. We did see the Trump administration effectively shut down access to the strongest Anthropic models. Now, it hasn't killed the AI trade, but there's just been a lot more divergence between what people refer to as the AI spenders and the AI enablers.
Now, at the risk of using the word unpack twice in one episode, David, you say AI spenders and AI enablers there. What do you mean by those terms?
So the AI spenders are the companies that are paying for the capital investment in data centers and chips. So really I'm talking about the hyperscalers there, Microsoft, Google, Amazon, Meta. It's a little bit smaller, but I suppose you could also include Oracle there as well. Together, they're spending about $1 trillion of investment over the next 12 months to provide the compute capacity that's necessary for AI. Now, they seem to be pushing ahead with all that investment, even if the cost of providing that compute will be hard to recover. So their share prices have been suffering. Meta and Amazon down 11 and 12% in the month. Microsoft down 17%. Oracle down 35%. I think it's pretty interesting now, actually, that Microsoft and Amazon are at their lowest PE ratios in 10 years. Now, you compare that to the enablers. They're the companies that benefit from that spending by providing the computer chips and hardware. Now, if that spending's going ahead anyway, then they can continue to do well. Micron, they had a really knockout sales result during the month. That company was up 19%. Intel has rumoured deals with Apple, Google and NVIDIA to manufacture chips in the US. It was up 22%. But then at the other end, Broadcom had a weak earnings result and was down 15%. So a bit of divergence within that semiconductor complex. And overall, that index has been really volatile as well. If I told you that in the last month, that index had down days of 10%, 8%, 6%, 5%, just across 4 days, you'd think that it was a terrible month. Yet over the month as a whole, the index was up 11%. So it's been really volatile. I think we're seeing a lot of profit taking in a lot of those names now that they've gained so much. But all of that really, I just want to kind of bring back to your comment about oil prices because, yes, US shares were down 1% in June. But I have talked a lot about the biggest companies being really weak because of that tech theme. If we do look at the equal weight index, which weights stocks equally rather than by market cap, that was actually up 2% in June. So overall, the market doesn't look too bad through that lens.
Now, David, one of the biggest stories during the month was, of course, the initial public offering or IPO of SpaceX. So it would be remiss of me not to ask about that. It was the biggest IPO ever. How did it go in the end?
Well, it certainly generated a lot of excitement, considering that SpaceX doesn't even turn a profit yet. It surged 50% in just 2 days. At one point, it was one of the world's top 5 companies. It made Elon Musk the world's first trillionaire. A bit of that excitement has dissipated now. It's fallen back quite a bit, but it is still up about 20% from its launch price.
All right, David, let's talk about Australian shares. Now they've been more muted, as you were saying earlier.
Yeah, and we've seen also in June a bit of reversal of the trends that we've seen over the year. So we did say that resources were the year's big winners, but they were actually sold heavily in June given commodity price concerns across the sector. Now, I will highlight iron ore. It is Australia's largest export. Supply from the large Simandou mine in West Africa is starting to ramp up. and that's putting pressure on prices overall. So BHP, Rio, Fortescue, they fell between 5 and 14% in the month. We did also talk about those big fall in oil prices. So Woodside and Santos down 8% each. But, we could get into base metals, uranium, lithium, rare earths, gold. There was basically just weakness across the sector, and the whole sector was down 8% as a whole. Now, instead, we saw some rotation back into the more beaten-up names for the year. Healthcare in particular, CSL and Cochlear were up 19% and 21% respectively. There are now perceptions that the RBA might be on hold. So that helped spur a bit of a rebound in some of the consumer names. Wesfarmers, Woolworths, Coles, they reach up around 12 to 13%. Though not every domestic name, I suppose, was positive. There was the small business lender, Judo Bank. That was down 40% in June. It did report higher than expected credit losses on a handful of business loans.
All right, David, let's turn to the month ahead, being July. Firstly, the US Federal Reserve meets again later this month. What's on the cards?
Well, we did have Kevin Warsh as the new Fed chair during June. He had his first meeting. He was very candid that he thinks that the Fed have been guiding the market too strongly and that they need to speak less and listen more. Now, I did mention earlier that about half of the committee members think they'll be hiking rates again this year. The next meeting is on the 29th of July. I think they will hold steady there again, but no doubt the market's going to question if and when we'll see a rate hike there.
And here in Australia, David, we heard during the month that the Reserve Bank of Australia might be moving in the opposite direction. What are your thoughts there?
Well, yeah, the RBA, to be clear, are still very worried about inflation. They did decide to keep rates unchanged, and that's just so they could take some time to assess the impact of the 3 hikes that we've already seen. They don't meet again now until the 11th of August. A lot's going to depend on the next inflation report, which we get later this month. But more and more people are thinking we may have already seen the end of rate hikes and that, in fact, yes, at some time in the future we might start to see cuts again.
Now, reporting season, that's also about to ramp up again as well, isn't it?
Yes. In the US, we start, I think, on July 14th. As usual, it kicks off with the big banks, most of the big tech names, late July, early August. And then, of course, Australia's reporting season also starts in August, though we will still see some quarterly updates from the resource companies during this month.
Before we clock off, David, anything else? And you haven't mentioned China yet. You normally mention China. Anything going on there?
Yeah, I suppose we haven't spoken about China. Economic growth there appears to have faltered in the last couple of months. Exports are still very strong, so that's driving strong activity there. But household consumption and domestic demand generally has been a bit weak. There is a Politburo meeting later this month, so we might start to see some more measures to boost consumption.
Very good. All right, we'll leave it there. David, thank you so much for coming in. Happy new financial year yet again, and we'll see you next month.
Thank you, Lyndon. See you then.
See you then. And that's it for today's episode. Remember, you can subscribe to us wherever you get your podcasts. We're also on the UniSuper YouTube channel, or failing that, you can check unisuper.com.au/podcasts at the start of each month. Now, a quick reminder that our Chief Investment Officer, John Pearce, will be releasing his next investment update video later this month, and I'm sure he will have a lot to cover, so make sure you keep an eye out for that one. As usual, it'll be on our website and our YouTube channel when it's ready. We are UniSuper, the place where bright minds and passionate people strive to think great and create a future worth retiring for. If you'd like to learn more about our investments, visit unisuper.com.au. Thank you for listening, and we'll see you next time. This podcast is general in nature, and it doesn't take into account your financial situation, needs, or objectives. So before you make any decisions about your super, we recommend that you seek financial advice first. Also, make sure you've had a read of the product disclosure statement and the target market determination that's relevant to you. They are all available on our website. It goes without saying that the past performance of any investment options that we talk about isn't indicative of their future performance, and it's worth noting as well that just by talking about certain companies, we aren't endorsing them for you to include in your own portfolio. Also, probably not a bad idea to mention that certain information contained in this podcast may include forward-looking statements, and we obviously don't guarantee that those statements will eventuate. And lastly, UniSuper has no obligation to provide updates or changes to the information in this podcast.